Hello everybody, I'm John, this is JP Strategic Investments, and today I want to talk about what happens to options when a stock splits. Now, the simplest answer is, well, the options split too, but that might be a little confusing and it doesn't really explain exactly what happens and why it happens. So I'm going to kind of use Tesla as an example here, show you exactly what would happen if we were to get another Tesla stock split and how it would affect their options. So let me just show you the options chain for Tesla here right now. And Tesla is currently trading at just over $1,150, right? So what I want to look at here, and just to keep it really simple, we're going to use a 2-to-1 stock split. So basically, if Tesla were to take each share and split it in half, so current shareholders, for every share they owned that was currently worth about $1,150, they would now have 2 shares that would total to equal that. So each share would be worth about $575 or so. Now, how does this affect the options? So let's just use, for example, we'll go to a nice whole number here, the $1,200 call, okay? So as you guys can see, the $1,200 call here is worth right now $16.85, or as we all know, the actual cost of that, because it's multiplied by 100, would be about $1,685. So how would this be affected with a 2-to-1 stock split? Basically what would happen is you would now get 2 of these options, and each of them, instead of being a $1,200 call, would be a $600 call. And the reason is because after a 2-to-1 stock split, right, if the stock is split in half, it's now worth half as much. Each investor has 2 shares for every 1 share that they had. Now it would take the same percentage increase to get to 600 as it did before to get to 1200, right? So basically the options are splitting at an equal percentage as the stock splits. So you end up with 2 $600 calls as opposed to one $1,200 call. And the reason you have 2 $600 calls instead of the call just going down to 600 is because, remember, each options contract controls 100 shares. Now that there are double the amount of shares out there, you have to now be able to control 200 because that's what would have been 100 pre-split. So now you end up with 2 $600 calls, and basically the premium for that option, or the price of that option, is also going to pretty much split in half, assuming that the stock price doesn't drastically change right when the stock splits. So just to recap all of this, originally you have a $1,200 call, it costs you $16.85, and the stock is currently trading at just over $1,150. The stock splits, it's a 2-to-1 split. The stock now goes to right about $575 a share. Every investor who owned 1 share now has 2 shares for every 1 share that they owned before. It's about $575 a share. Your option, your $1,200 call, also splits into 2 $600 calls, right? Because before you owned or you controlled 100 shares with that option. Now, because there's 2 shares for every 1 share that there used to be, you now control 200 shares for the 100 shares that you used to control. 100 for each $600 call. Each of those calls now is worth half of the original premium. So the premium was about $17. Now each call is worth about $8.50. So that's exactly what happens with your options when a stock splits. So are there any benefits or downsides to this? Not necessarily in regards to whether those will be worth more or worth less. There are actually, though, 2 benefits that I think everybody should be aware of when it comes to options and stock splits. The first one is that now you have 2 options for every option that you had before. So let's say you only owned one of these $1,200 calls. Well, if the stock goes up and you want to take some profit, you pretty much have to sell the entire call, and now all of your money is off the table. With the 2 calls now, if you own 2 $600 calls, now if the stock goes up and you just want to take a little bit of money off the table, you can sell one of those calls and keep the other call, and as the stock moves up, or if the stock moves up further from that, now you're risking less, but you still have the opportunity to make profit if the stock increases. The second benefit to options when a stock splits is a very similar benefit, and that is that now, since the share price is lower, options overall from a sheer dollar amount will be cheaper, right? In this case, the $1,200 call, basically if you were betting on the stock price increasing in value by a particular percentage, now you can bet on that same exact percentage increase, but at a lower price, right? Each one of these is now worth about $8.50 as opposed to $16. That's a pretty big difference when it comes to trading options, especially if you're trading with a smaller account. An option that's trading at $16 may be kind of out of your price range, whereas an option that's trading at $7, $8 might be more realistic for you, and you won't have to risk as much of a percentage of your portfolio to trade that option. So anyways, I hope you guys found that helpful. I hope that kind of answered most of your questions when it comes to options and stock splits. If you do have any more questions, definitely leave those in the comments below. And other than that, I will see you guys next time and have a great day.